Hey everybody, welcome back. So yesterday I made a little video, is this going to be a crash? And one of the things that I said we should wait and not be kind of piling all our eggs into the basket is to see, first of all, what earnings are going to be like this quarter. And, I want to go through because we've had three of the big banks report earnings this morning, and we're kind of giving us, like obviously there's a ton more earnings to come, but it gives us a good taste. Now, here's what we're going to look at. I'm also going to teach you how I actually trade earnings. Okay, I made a whole video. If you want to go and find it somewhere, I don't have that many, but made a whole video on how everybody gets lost when it comes to trading, and they all are looking for this, this magic panacea. Well, it's all down here. Right. One of the main reasons why I use Thinkorswim is simply because because I can see what the earnings are, right? And it's very easy for me to look at price in context of the earnings and then make some decisions. Now, it's not cut and dry, simple. Oh, they made 171 and it's going to go higher. They made 165, it's going to go lower. But sometimes it really is that simple. Sometimes you have to dig a little bit deeper into it. But for the most part, if that's all you did, the best indicator in the world, the absolute best indicator in the world, is right down along the bottom of this chart. Right? So, for example, here we see they made 107. Now, just look at the last 1, 2, 3, 4. And you can see at 107, that's not a good number. Now, sometimes things are seasonal, so you got to take that into consideration. So, what I will do is I'll go and look at the quarter before, and that was 171, right? And it's like, okay, so that's not a seasonal effect. I could go back more if I wanted, but I'm going to keep it simple. So I know, at 107, when we are up in these nosebleeds area, that this is potentially going to be correcting this quarter. Remember, Wall Street works from one quarter to the next quarter. I want you guys to remember that. We're in a quarter-based driven society on Wall Street. We live for quarters. So when we get up here, now I can start to look for reversals. Right now I can start to look for shorts. Okay, because I know that that's a really bad number in context. Right. Here's an example, 237. Now, what probably happened here is they probably had some type of write-off, so you got to be a little bit careful about it. But I'm just saying, if you just want the best indicator in the world, this is it right there. Okay, so whatever excuse they come up with is whatever excuse they come up with, but doesn't change the fact. But that whole quarter, I'm going to be looking for shorts on JPM. Now here's an example on the opposite where they have 237. Now, also this number here is pretty big, right? So again, I'm gonna be looking for longs, right? Now, I'm not gonna teach you how to trade. You've got to learn how to use order flow. You got to learn things like liquidity, 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 right? Liquidity, look what happened at these three liquidity levels, right? And then finally it shoots up, and really, like I said, if you want the best indicator in the world, it's right there on your charts. Okay? If you want to learn how to really use it effectively, then go ahead and take my class. Okay. Now let's talk about what we have going on here. So JP Morgan came in. It doesn't show it here for some reason. Usually it's really fast. 234. So that's a good number in context, but it really is not a great number as far as the last three quarters are going. So they're not improving, which is just basically telling me that this is just a function of higher interest rates, because remember, they are a bank and they make money. They make more money when interest rates are higher, and it's probably also a function of the tax cuts that are really kicking in for them. So it's a function of the two. So 234. Now, can we justify these levels at 234, right? Can we justify these nosebleed levels at 234? And I think the answer is no. Right? I think the market really needed something like a 270, something like a 280 in order to really justify these levels. So at 234, basically my trading plan on this right now is, sort of a short bias, but I'm not going to just plow in to shorts. Again, I want to use things like liquidity. I want to use different things like understanding levels. I want to understand support and resistance really properly. I want to understand acceptance, rejection. These are all the things that I teach in my class. I want to understand the order flow. So to me, going forward for the rest of this month, JP Morgan is going to be a short bias, but it is a patient short bias. Meaning I'm not going to jump in right now this morning and start shorting it. I'm going to start to work off all my key levels, and I'm going to start to say, okay, what are the key levels that I could be shorting? I would love for JP Morgan to get back up to these highs at 119, right? That would be a phenomenal level that I would love to short that at, right? 112.50, that would be a level that I would want to start shorting it at as well too, right? So I have short bias, but it is it's not an aggressive short bias, it's a passive short bias, meaning that I want to sell into any strength and I have really no fear. Again, the greatest indicator of all is right along the bottom of your charts, okay? Now let's look at WFC. WFC came in at 113, which is Wells Fargo. Now, Wells Fargo has a whole bunch of problems attached to it. They've got all kinds of fraud issues. They've got they were being fined. There's a whole nightmare attached to WFC. So 113 versus 98, 112, 116. Pretty much the same pattern as JP Morgan, right? You can say they had a bigger beat over the third quarter last year, right? So again, I'd say that's an okay number. Same story, kind of a passive sell, right? Passive selling to me, which means that I don't want to jump right in, but man, I would absolutely love for WFC to get back up to 159. I would be all over that like white on rice, and that would be, I'd be loving that. Now, also for my students that understand order flow, okay, keep that in mind. Look at the whole context of the situation. So again, a passive short bias. I'm not going to jump right in today, although I do think we're going to go pick up some liquidity down here at 50.31 before we go higher. So I do think 50.31 will be tested before we go higher, maybe even 49.27. Now, would I buy it? And the answer is, I like to pick a side, right? I like to pick my battles. So I kind of prefer, I might, right? But I really like to pick my battles. And quite honestly, I'm just personally a much better short seller than I am a long. I don't know what it is. I have like some curse against me when I try to go long. I tried to smell long on the spider earlier this week, and it just ate me alive. Every time I try to buy a market, I get spanked. I don't know what the heck it is. I swear to God, it's some type of generational curse. But I'm just a really good. I make a lot more money. I make 10 times more money short selling than I do long. Don't ask me why. And even in a bull market, I make a lot more money short selling. Okay, so that being said. Do I buy it? Maybe, right? But I would like to see that number, like 120, right? 120, like beat that 116, right? 120, right? And then, then if that was 120, then I would be really aggressively looking for longs, or more aggressively looking for longs than shorts. Let's look at the final one, C. Okay, 173. Now that is what we needed to see. Okay, we needed to see exponential. We needed to see improving growth, and this is the only company that got it. Okay, so 173 is what we needed to see in this context. So in this particular context, rather than have a short bias on this, right, I would have a long bias on this particular asset. But I'm not just going to pile in right now, right? I'm not just buying right now. I mean, we did pick up a little bit of liquidity off of this 168.82 level. There's more liquidity sitting down here at 168. So again, it's not an aggressive long, right? It's just a more passive long. Like I would absolutely love to get down, to 164.24, and that's where I'd be all over it. Maybe even a little lower, like probably something like 162.80. I would be a big buyer of that. Okay, and as for my students that are following the order flow, you'll understand why that would be a very aggressive buy. You can just look at that chart and you'd understand why that would be a very aggressive buy at 162.63. I would put a lot of money into that trade. Okay, so again, if you the greatest indicator of all, and everybody doesn't talk about it, is right down here on your charts. Okay, that's the main reason I use Thinkorswim, because I can easily see it. Right? I don't keep too much money in here. I'd keep a small account here just because I love the charts. They're laggy. There's all kinds of problems with this company. They're really great if you're doing options, right? But they're laggy. They're terrible. As far as data is concerned. They're a horrible company. They're way more expensive, but the actual technology that goes behind their charting is absolutely incredible. I've had Thinkorswim and I have IB on my other screen, and it's always lagging. Like not just occasionally, it's always lagging. Okay, so now big review. Going back to the bigger picture, we've seen some indication now of what the earnings are. And remember yesterday I said, are we going to have a crash? And the answer to that is we very well could now. So earnings are so far, remember there's a lot more to come. So far these earnings are not stellar, right? So right now I do see, with the threat of the midterm elections and the Republicans losing control of the Senate and House, I do see more threat to the downside, right? So that just added, like I said, being adaptable as a trader, that just added more context to my short side. But again, I don't want to aggressively sell just yet. Okay, we're not in aggressive sell mode. As we get closer to November 6th, and we start to see more talk of the election, I think the volatility is going to pick up. And I think that the path of least resistance right now in the short term, in the long term, the path of least resistance and smart money's buying. We know that, okay? So don't get confused about that. But in the short term, the path of least resistance is lower, and, with the threat of potentially losing the House, and the Senate, we could have a deeper correction, right? I'm not talking about a catastrophic one, but we definitely could have a deeper correction for now, okay? But so far, earnings are good. They're not bad. That's what we see. Okay, there's my update. Hope you guys enjoyed that. If you want to learn how to really trade, understanding, how to read earnings is one thing. Is it improving? You could give this to a 16-year-old child and say, is this good, bad, or ugly? Right? And they could figure it out, right? And or good, bad, ugly, or indifferent, really. And quantify it. How good, how bad, how ugly, how indifferent, right? If you want to learn how to trade, It's one thing to be able to read these things, but it's another thing to be able to understand how do I read the overall order flow, and then how do I devise a strategy of exploitation. And quite frankly, really the only one that really excites me that goes with the order flow is Citigroup, but I really need 6280 on Citigroup in order to get into that. So I'd have to sit on my hands until 6280 if I was going to trade any of these banks, because that's the only one that's following the order flow. Okay? All right. You want to learn how to read order flow? You want to learn how to really make money in the market? You know, sign up for a free 20-minute Skype call, and we'll discuss what you're doing now and how I can change your future. Okay? Thank you. Bye for now.